The $36 trillion question today is, with the U.S. debt now at 100% of GDP and a daily interest cost of $2.6 billion, we're just one crisis away from what's called debt monetization. And how is this going to affect you? My name is Paul Carroll. I'm the CEO and founder of Avion Wealth, an elite wealth management firm based here in Texas. Let's talk about some budgeting realities. Right now, revenues are $5.16 trillion. Spending is $7 trillion, which leads to a deficit of $1.9 trillion. That's 6% of the GDP of the country. The problem, and we talked about this in previous videos, is how much of this can be cut. Mandatory spending, that's Social Security and Medicare, is 63% of the total amount. Interest payments are 14%. And as interest rates go up and the debt increases, those interest rates, both absolutely and as a percentage of the budget, will continue to go up. Defense spending is 13%. We live in an unstable world. I don't think many people are calling for a significant trim of defense spending. And true discretionary spending is just 10%. And people say, well, there's a lot to cut. One of the interesting things about DOGE is everywhere they looked, they discovered there isn't that much left to cut. Most of the savings have been cut away over the last decade. In fact, some of these agencies have been cut so much that they're running inefficiently. They actually would be better and run more efficiently with extra spending in the short term. There's not a lot of room to cut. Projections show the debt reaching 118% of GDP by 2035. The other problem we have is Fed independence is under threat. There's a bit of a pressure campaign coming from the administration. You know, we've had Powell called a lot of things that are a little less than complimentary. There's been a demand from the White House for immediate rate cuts. And the threat of termination for Powell. There's big problems with these moves. As soon as there's a loss of confidence in the Fed, especially Fed independence, the markets, especially currency and bond markets, react ferociously. And they do so for good reason, because experience shows that that's not good. We had this happen in the Nixon era. It hurt very badly. It hurt even more fixing it. The dollar, as a result of these comments, hit a 3-year low on concerns of independence. Gold surged to $3,500 an ounce. Treasury yields have spiked. When Nixon pressured Burns in the 1970s, we got stagflation, and it took Volcker and record high interest rates to get it back under control. The stakes are high. An independent Fed is necessary for credible inflation fighting. As the debt continues to grow, and the big beautiful bill will make it grow a lot more, we now have just 3 ways to solve the problem. One, you can cut spending. Well, as we've already discussed, there's not a lot of places to cut it. 63% of the budget is going to seniors, and they vote. The second way is to raise taxes. We've already seen that the will to raise taxes significantly on some groups is just not in the cards. So in democracies throughout history, the third way is usually the way that's gone, and that is monetizing the debt. What is monetization? Basically, the Fed prints money to buy government debt. We last saw it in World War II. We also saw it during quantitative easing from 2008 to 2014. But that was done because inflation actually threatened to go below 0. And the difference was quantitative easing was temporary. Monetization is permanent. What are the warning signs? If we see Treasury auctions fail, meaning the Treasury cannot sell the debt they put up for auction in any of those cycles, that's a warning sign. If debt to GDP rises above 100%, 130%, and when you see political pressure on the Fed to buy that government debt to fund spending, that's a pretty surefire indication that monetization is coming. Historically, what's happened? In the 1940s, we had what's essentially called financial repression. Negative real interest rates after factoring inflation meant that retirees saw a fall in the standard of living. In the 1970s, we saw stagflation, not only were we not making any money, but the economy was slowing down. We were running into inflation and the economy was slowing down at the same time. We talked about in Germany, Weimar, the hyperinflation. So in summary, how do we protect the portfolios from the risk of monetization? Well, certain assets will fail in an inflationary environment. Long-term bonds. Our company, as a rule, we never invest in long-term bonds, be they treasuries or anything else. Intermediate-term bonds will get hurt, but not as badly. Short-term is a lot safer. Cash and money markets, even though those are essentially ultra-short-term bonds, when you have high inflation, you essentially have negative interest rates because the interest rates tend to not keep up. You're watching your money depreciate in value. Fixed annuities. And it can be an annuity from an insurance company or it can be a defined benefit pension plan. You're getting that defined benefit of $1,000 a month. It is almost never indexed to inflation. And finally, high price earnings growth stocks. The very same stocks that are driving the market today, the Mag 7, are high PE growth stocks. There are investments that do work well in an inflationary period. We call them inflation hedges. We've got commodities. And that can be energy, agriculture. We've got gold. We've got TIPS, Treasury Inflation Protected Securities. They are inflation protected and they have extremely low yields as a result of the fact that the yield does not include the inflation prediction. Real estate can be a great hedge as long as it's in the right location. Anybody who bought real estate in Austin 2 or 3 years ago is probably still licking their wounds. It's a very local market. And now the new game in town is digital currencies, Bitcoin. Some of these currencies probably will turn out to be good hedges against inflation, others will not. And the stable coins definitely will not. So what are we recommending our clients? Well, it's very much a function of their risk tolerance versus the tolerance for inflation. I love the analogy of the frog. You know, when you put a frog in boiling water, the analogy goes, it jumps out of the water. That would be a volatile stock market. But if you put the frog in cold water and just slowly turn up the heat, it will boil to death. That's inflation. In my opinion, inflation is a greater risk than market instability, market volatility. So we would bring the client in, we'd find out what's your tolerance for inflation, what's your tolerance for fixed assets, for commodities, what is your willingness to stay short-term on the debt? These are conversations that need to be made on a one-on-one basis. And we invite you to have those conversations. So in conclusion, we're expecting 3 likely scenarios with different probabilities for the 2025 to 2030 window. One would be a soft landing, 2 to 3% inflation. Powell does a great job. It's probably a 30% probability of that happening. Second, persistent 4 to 5% inflation, most likely scenario. There's a lot of pressure on the economy. There's a lot of pressure on the Fed. 4 to 5% inflation devalues your portfolio pretty significantly over time. And then we've got what's called a debt crisis and monetization. That may be the lowest probability risk, maybe a 20% probability, but it will be devastating if it happens. And so we have to consider that when we're putting together an asset allocation. Action items for our clients is to audit the portfolio for inflation exposure, to establish some kind of commodity or inflation sensitive position, and monitor the Fed independence. Inflation is very much a policy choice, and we need to prepare accordingly. If you found value in this series, we'd love to hear your thoughts. If you're concerned about inflation and the risk of monetization of the desk, how that may affect your portfolio, you need to talk to us. We'll walk you through the scenarios, we'll walk you through what you can do and what you cannot do to protect yourself from the upcoming inflation. This can be managed. It doesn't mean it's going to be pleasant for society, for the public at large, but there are things you can do to protect yourself. We wish you the best of investment success. Thank you.